policymakers talk about the quantity of credit without talking about the quality of credit or the directions of the flows of credit. So if you let it get into stock buyback markets, what you see essentially is just an artificial inflation of share prices that has nothing to do with underlying value. In the housing market in the 1990s, you saw housing prices just shoot through the roof because credit was misallocated to those particular markets. And then when those markets go bust, other markets that weren't misallocated credit end up being caught up in the storm. So I think you've got to allocate credit carefully in order not to have bubbles and busts. In other words, fine-tune the flow of credit money to see to it that it's flowing in productive directions rather than price bid-up directions. And the greatest irony is that the Federal Reserve was originally designed to do just that.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you could support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia Pino.
And it is our privilege today to be talking once again to Edward Cornell, Professor of Law, author of many really helpful articles, essays and books, public finance consultant, and all-round just one of the good guys, Professor Robert Hockett. Thanks for joining us today, Robert.
Hey guys, the privilege is mine, and it's an absolute joy to be with you guys again.
So we wanted to talk about your recent Forbes piece, Fine-Tuning Monetary Easing. In that piece, you propose a way for the Fed to mitigate some of the side effects of its monetary easing of recent years. Just to be able to understand the problem and the solution, I thought listeners might need a bit of priming. So what is a derivative, and how does the derivatives market impact on our everyday lives?
As you might have noticed, I was sort of reprising something that I pushed about 12 years ago during the last time that the Fed was innovating in the realm of monetary easing. As you guys know, monetary easing can be quite helpful as a sort of a demand support mechanism when there are challenges to maintaining aggregate demand, such as tends to happen in things like financial crashes or global pandemics. You know, on the one hand, easing of that kind can be helpful, at least as a stopgap until such time as the fundamentals that are ultimately to blame for a monetary and fiscal dysfunction can be addressed and solved. But one unfortunate side effect is that there is a tendency for speculators, speculative entities, hedge funds, other sorts of Wall Street entities to find or to get hold of the cheap money that's made available by monetary easing and to use it to speculate on commodities markets. Basically markets for various financial instruments that are associated with foods and fuels and minerals and things of that kind. And when the speculators are basically betting on the instruments that are associated with those commodities, they tend to drive up the prices of those securities, at least temporarily, right? At least for brief intervals. And then the prices of the commodities themselves tend to follow the prices of those securities, those derivatives that we'll get into in a moment. And so what tends to happen then is you get a great deal of price inflation in markets that sort of disproportionately matter to those who are not up at the top of the income ladder, right? People who are on fixed incomes or who have lower incomes, a much larger portion of their daily expenditures go toward, say, heating oil or fuel for their automobiles or foodstuffs, than is the case with wealthier folk. And so when the prices are volatile, when they're sort of swinging wildly, and especially when they're on the upswing, that tends to be quite harmful to those folk. And in that sense, you can get a very regressive sort of impact or side effect from a policy whose sort of main effect is motivated by something other than that, and indeed might indeed be justifiable. Now, getting to the instruments themselves that the bettors bet on in order ultimately then to affect those prices, these are the derivative securities that you guys asked about. And in essence, I think the easiest way to sort of grasp what a derivative security is sort of intuitively is to think of it as a sort of tradable insurance policy first, and then second, to kind of remind yourself of the sense in which an insurance policy is a kind of bet, opposite sides of which the insured person and the insurance company are taking, right? So, Patricia, if you purchase home insurance, let's say it's insurance against fire that might afflict your house, there's a sense in which you're betting that a fire will occur, or at least could quite possibly occur, because otherwise, if there was no chance of a fire occurring, it would be sort of senseless for you to pay the premium on the insurance policy. And the insurance company, of course, for its part, is betting that a fire won't break out, so that it won't have to pay anything out to you and will simply take in the premium that you're paying. So in that sense, you and the insurance company are taking the opposite sides of a bet. Now, the insurance policy is such that it cannot itself be traded. As you guys know, in common law jurisdictions, that's to say legal jurisdictions that sort of descend from the British legal system, including yours and ours here in the States and the Canadian and so forth, there's a doctrine at work in insurance law called the Insurable Interest Doctrine. And what that effectively does is it basically prohibits you, Christian, or me, Robert, from also purchasing insurance policies on Patricia's house. In other words, we're not allowed to bet on the prospect of Patricia's house catching fire because we don't have any ownership stake in that house. It's not ours to sort of gamble in connection with. And so that places some limits on, sort of the degree to which bets can kind of get out of whack or go crazy in actual insurance markets. But what derivatives markets do or what a derivative security is you can sort of think of it as an insurance policy to which the insurable interest doctrine does not apply. So imagine that Christian and I could find people who are willing to take the opposite sides of our bets in placing bets on Patricia's house, right? How Patricia's house fares, whether it catches fire or whatever. And I think I'll switch examples quickly, Patricia, because I'm beginning to feel uncomfortable talking about your house.
I don't own my house, so it's fine.
Oh, well, right. So it's a landlord. But if it were possible for Christian and I to place bets, let's say that I imagine, that there is a strong chance that your house might burn, and Christian is pretty sure that it won't because it's full of asbestos. Let's say, just to make this as perverse as possible. If Christian and I are able to find a market, or even find each other and place bets on the prospects of your house, and we can reduce our bet to a contract in an enforceable contract, in the sense that Christian can force me to pay if I lose the bet, and I could force him to pay if he loses the bet. Well, then you have something much like an insurance policy, but it's no longer constrained by the insurable interest doctrine. And if Christian and I decided to make a market in this particular security and got other people to place bets on it as well, in theory, there's no limit to how many people might place bets on this, right? And so you get, in a sense, a market in certain financial securities that are functionally like insurance contracts, but that don't limit the number of bettors pursuant to the insurable interest doctrine. Now, that's a very generic description of a financial derivative. To get a little bit more concrete, or at least a little bit more specific, there are lots of specific derivatives contracts out there that are associated with particular markets. So you've heard presumably of oil futures or other kinds of commodity futures. These are basically just contracts of the kind I was just imagining. But what the bets are on the prices of commodities themselves, right? So you're basically betting on price behavior. Now, in theory, markets of this kind could be useful because they enable people, in effect, to insure against price volatility in particular markets where price volatility can't really be borne, where people have to be able to plan their affairs. And in planning their affairs, they have to have some sort of certainty as to how much they're going to have to pay out of pocket for various goods or services or what have you. So derivative contracts you can think of as insurance policies against sudden price changes in particular markets, which is kind of ironic if you think about it, because the fact is then they're meant to offer people means of hedging against price volatility. But where the problem comes in is when there's an awful lot of speculative money cheaply available, so that people, basically hedge funds, can borrow really cheaply in order to make bets of this kind. Very oftentimes the betting behavior itself has an influence on the underlying prices. It's not merely a sort of dependent variable that varies with the independent variable, that is the commodity price. Oftentimes, the causal relation can be reversed. So what was meant to be the dependent variable, namely the derivative price, becomes the independent variable, and the underlying commodity price becomes the dependent variable, the one that varies with the betting behavior. And this is especially true in markets that tend to have a relatively small number of participants that aren't especially well regulated, that tend to function sort of like clubs where lots of people have lots of inside information. And unfortunately, the commodity markets, the derivatives markets, are often characterized by those properties. So what we've got going on, in effect, is a kind of monetary leakage, right? The fact that monetary policy is a very blunt instrument, is not a very well calibrated tool, at least as it's currently constituted. You get a lot of leakage of cheap money that it was hoped would go into fueling continuing consumer demand in order to keep people employed. You get it sort of leaking from that intended use to these unintended and potentially highly problematic and volatility inducing sort of avenues. I think when you guys and I talked sometime in 2020, I think an analogy I tried to draw was that between the old sort of carburetor system of fueling an internal combustion engine on the one hand, and a fuel injection system of fueling such an engine on the other hand. Happily, those engines, all of them, will soon be no longer used, and this will be a self-dating sort of analogy to draw. But I assume that there's still enough memory now of carburation and fuel injection to sort of appreciate the distinction. If we had a more sort of fuel injection style monetary policy regime whereby you could actually channel the loose money down specific avenues and prevent its going down other avenues in the way that a fuel injection system sends the fuel to specific cylinders in an engine rather than just throwing a bunch of flammable liquid at the whole bloody thing in the way that carburetors could sometimes do, then you've got a much more, I think, efficacious and non-leaky or even leak-proof monetary policy system. So what I've proposed here, and again, I started this back during the last time that QE was innovated because the same thing happened then, is that the Fed actually target particular derivatives markets and act as a sort of giant contrarian thinker and investor to sort of counteract the effects of the speculators in order to collar the prices of the commodities in question so that they don't swing wildly upward or downward, so that then ordinary folk who are not at the top of the income ladder can sort of plan their affairs and also not, bankrupt themselves just to sort of keep themselves fed, but only to do that and for as long as is necessary until we can really address the underlying problem, which really has to do with production and productivity. And I'm sure we'll get into that in a bit. But that's, believe it or not, the sort of short playing summary version, even though it's long-winded.
Can I ask, derivatives are just an instrument that mirrors the or is related in some way to the price of an underlying asset, like future contracts. Is the volatility in these derivatives market driven by the fact that perhaps, institutions have a lot of cash going around because of QE and other things? It's not that the derivative is directly affecting the price of the underlying commodity, but is it that those derivatives are themselves used by the producers of such commodity and thus included in the cost of manufacturing or producing these goods? Is that the right way of looking at it?
Yeah, it's a characteristically great question, Patricia. And I think the answer is in a sense, both, right? So on the one hand, to take your second point first, it is true that the price of hedging by producers and by middleman institutions that are sort of brokers between, say, producers or extractors of goods or resources on the one hand and end users on the other, is itself a price that goes into the supplying of those actual physical things. And accordingly, volatility in those particular hedging markets can, in that sense, or through that sort of mechanism, affect the prices of the underlying commodities or other goods as well. But in addition, the first possibility that you countenanced, Patricia, can also operate, because there is oftentimes a tendency for folk who see a derivative price going up to go ahead and buy more of the underlying item as well.
So sort of a mirroring effect.
Yeah, exactly. And financiers actually just call it the underlying. I'm always uncomfortable with that, but you get the idea, the underlying on whose price the betting is happening. I sometimes find it easier to kind of think these things through by imagining a kind of stratification of the markets out there. So you can imagine primary markets in the physical goods and services that people purchase. You can imagine then secondary markets in the financial instruments that are issued by the companies that supply or produce these goods or services. And then there are tertiary markets in the derivative instruments whose prices themselves are tied to the prices in the secondary markets or in the primary markets. So one way to then describe what's going on using that sort of schema or that sort of schematism is to say that, ideally, prices in the primary markets would drive or determine the prices in the secondary and the tertiary markets. And in the long run, that does tend to be the case. But in the short to medium run, oftentimes the prices in the secondary markets or the tertiary markets can kind of come unglued or unmoored from the prices in the primary markets. That's, of course, what's going on when a speculative bubble or bust is underway. And then even worse than that, sometimes the prices in the secondary or tertiary market can feed back into the prices in the primary market and cause those markets to become dysfunctional. And the sort of prerequisite, it seems, for that to happen, or at least one of the prerequisites, is that people who basically buy only with a view to selling, i.e. people who are only speculating, whose primary motive is speculation, are able to borrow cheaply in conducting their speculations. And so what they effectively do is they find the cheap money that comes to be abundantly available in the midst of some kind of monetary easing that's done with a carburetor rather than with a fuel injector. And they end up, of course, then driving those prices sort of out of all real relation to primary market prices. And then they can feed back into the primary market prices via the two mechanisms that you just imagined.
As far as I know, when you buy a derivative product, you only have to put in a portion of the value of it. Does that just make the problem a lot worse?
It does, yeah. Because that, in effect, is leverage, right? You've effectively functionally defined a term that financiers are very content for people not to know the meaning of. But it boils down to something quite simple. And it's just what you said, right? I mean, basically, if the so-called skin in the game or the equity that you have to sort of supply in making a purchase is lower, and the amount that you can borrow or the amount of credit that you can use in financing the purchase of a speculative instrument is high, then the volatility tends to become correspondingly higher as well. Another way to put it would be to say that the degree of decoupling between the price of the secondary or tertiary market instrument on the one hand and the underlying primary market service or product on the other hand becomes greater. There's more unmooring, more untethering, and things can become quite crazy. And that, by the way, is why you guys might remember back about maybe just shortly actually before the financial crisis, there was about I think 2 month or 3 month period where petroleum prices were just shooting through the roof. And there hadn't been any quote unquote change in the fundamentals to sort of explain that. It's not like a bunch of wells suddenly burned or a nuclear bomb was suddenly dropped on Saudi Arabia or something, or, the Iranians threatened such a thing all of a sudden. There was no quote unquote fundamentals based explanation for the prices just suddenly shooting through the roof. And it just turned out that a whole bunch of money had been made available or had become available to speculators because the Fed was already beginning to ease monetary conditions because it saw, this was after Bear Stearns, but before Lehman Brothers. So the Fed was sort of beginning to take preemptive measures to try to forestall a Lehman moment, such as happened 6 months after Bear Stearns. And speculators began to get hold of that cheapening money and were gambling on petroleum prices. And bear in mind also that sometimes the gambling is it's not like they're just betting on a sort of an insured event or a factor that they can't control. Oftentimes, they're able to exercise some sort of control on the underlying market, and then they place their bets, in effect, to capitalize on their capacities to sort of control things. The analogy here would be, let's say, Patricia, to go back to the fire example. Imagine that there was some way for you surreptitiously to burn your own house after taking out the policy and after, of course, conveniently emptying it out of all of the possessions that you actually care about. And then you could somehow basically make the fire happen and make the house burn down and not be caught and prosecuted for arson or whatever, and then collect on the insurance contract. Well, that's a very well-known form of insurance fraud. And of course, what makes it possible is the fact that sometimes the so-called insured event is not actually statistically independent. It's not an independently varying variable. It's something over which the policyholder is able to sort of exercise some sort of influence. And, unsurprisingly enough, we refer to that as moral hazard in the insurance markets. But for some reason, people don't use the term moral hazard in the derivatives markets, which are basically just, sort of unmoored, untethered insurance markets. And so there's a lot of moral hazard that's not just a hazard, but is actually realized, that actually happens or occurs or eventuates in those markets precisely because of the sort of clubby nature that I mentioned before of these markets, not only the derivatives markets, but also the markets in the underlying commodities themselves, the petroleum markets, the copper markets, a lot of the foodstuffs markets, and the like.
You mentioned that there is various ways of kind of betting in this derivative market. And one way that there is of betting on it is to combine products so that in combination, you're betting on high volatility or low volatility. And what you seem to be proposing with the central bank's kind of intervention would be to effectively reduce volatility. So would you see that as a means to discourage basically speculative behavior or reduce that sort of activity as well?
Exactly. Yeah, that's exactly it, Patricia. The idea here is that the real key point, I think, that laypersons might not initially know, because again, the financiers try to kind of conceal this, is that speculators aren't simply betting on price rises or price falls. They're basically betting on the movements themselves, and they're betting on their capacities to predict the movements before they occur, and thus to place the bets on the movements. And so the speculators, in effect, need the volatility to make the money that they make. That's their business model, is simply to bet on the volatility as such. And so one way to look at the proposal is as basically taking the volatility out, and insofar as in so doing, taking the profit-making capacity out of those markets. Another way to look at it, which is sort of complementary to that way, it's entirely sort of consistent with it and kind of coheres nicely with it, is to take the incentive out of the kind of betting that the speculators do. Because if they understand that when they place speculative bets, the world's largest financial entity is going to be taking the opposite side, they might eventually decide maybe to go bet on something else, right? Like slot machines or something. So if the Fed is your sort of counterparty, you don't want to bet on your own capacity to sort of, have a longer sort of liquidity life than the Fed itself, since the Fed can issue the world's primary liquidity instrument ad libitum. That's not a counterparty you're going to win against. You guys probably remember, you sometimes hear references to George Soros or something, and they'll say he's the guy who broke the Bank of England, back in 1842 or whenever it was he supposedly did that. And that might be possible, or might have been possible at some point against the Bank of England, but I wouldn't want to try it against the People's Bank of China, the Bank of Japan, or the Federal Reserve, or the European Central Bank, for that matter.
What do you think the main objections, if any, to this might be from the investors community? Because what I preclude they might say is that they need, the volatility or those changes are important in order to hedge against changes in the underlying commodity or whatever.
There's a kind of a standard menu of objections that they always raise. And, most of them, I think, best warrant a kind of snicker, or at best, and a sort of spit take, spitting up of your coffee at worst. But, the one is that, the derivatives traders and the hedge funds perform a useful service in sort of smoothing volatility over time by providing, counterparties or betting markets so that people can hedge and all of that sort of thing. And that would be true if we didn't have the sort of enormous quantities of cheap credit money available that we have during monetary easing for them to operate with. And it also would be closer to being true if the markets themselves weren't clubby, right? If they weren't basically sites effectively of oligopoly trading or insider trading or insider information using or market cornering or the like. In other words, if these markets actually conformed to the classic image of, a sort of market where people have symmetric information and equal bargaining power, nobody has the capacity to move markets. Everybody's a price taker. Nobody's a price maker. If markets were of that character, then there would be some, at least kernel of truth to that observation, but what they always conveniently leave out. And they know that they're leaving out. And so in that sense, they're simply lying.
I always wonder whether they know they're leaving it out. I'm glad you say that they know.
Yeah, those who actually trade in those markets and those who actually know those markets are simultaneously the ones who stand most to lose by any proposals of the kind. And they're the ones who know these markets the best. And it's sort of no coincidence that those who stand to lose the most and know them the best are the ones who object the most vociferously, using mendacious arguments that mischaracterize the character of those markets. But so that's one line of objection, of course, that we're going to hear. Another that we'll hear sort of dovetails off of that one. It's a slightly broader or more general, quote unquote, argument, but they'll say, public instrumentalities or public entities shouldn't be in the business of, quote unquote, picking winners and losers. They shouldn't be, in the words of, reactionary U.S. Senator Pat Toomey in some Fed hearings last week, quote unquote, allocating credit. But of course, with those objections, sort of overlook or, sort of, I suppose, intentionally elide past are two facts, right? One is that we pick winners and losers all the time. And right now we're picking them as the winners. And we're picking lower income folk as the losers. That's the first point, because they leave out the fact that that cheap money that they're speculating and betting with is all publicly issued. And it's publicly issued with a specific public purpose in mind, and is a purpose that they themselves are perverting, that they are distorting and twisting and basically rendering less effective, more harmful, and hence more controversial and less likely to be able to persist. The second reason that it's a sort of disingenuous argument is that, they themselves and most people, at least implicitly, I think, recognize that there are some prices that are what I think of as systemically important or systemically significant. And indeed, the very fact that we have central banks that engage in open market operations in other securities, namely treasury securities, in order to affect the money rental rate is evidence of that fact. Similarly, the interventions that were made starting in 2012 especially, but to a certain extent even before that, in the mortgage markets and in the mortgage-backed securities markets and in the mortgage related derivatives markets by the central bank, in the wake of the last crisis, those two indicated that we view housing prices in an economy where the primary asset owned by most members of the middle class is their housing, are systemically important prices. That is to say, they're prices that go into the making of other prices, and they're prices that the entire economy, in a certain sense, is affected by, rather than merely one narrow or two narrow markets being affected by. As you guys know, as we all three have argued, prevailing wage and salary rates are also systemically important prices. It's one of the best arguments that's ever been made for the so-called job guarantee, right? It's a kind of open labor market operation analogous to the open market operations that the New York Fed engages in each day in the treasuries market, because, of course, prevailing wages and salaries go into the making of other prices, not only the prices of things that are produced or the services that are rendered, but also the prices of other things, because, of course, aggregate demand is dependent on people's actually drawing incomes. So we intervene quite commonly in various markets where the prices are sort of systemically important, where there are spillover effects or externalities that matter. And it's sort of, again, disingenuous at best and just outright lying at worst to suggest that, any kind of picking of winners and losers is somehow illegitimate, And it dovetails, I think, with the first pseudo objection as well, because the only reason that, or at least the primary reason that interventions of that kind are necessary to stabilize the systemically important prices is precisely because the markets themselves don't conform to that sort of neoclassical model where everybody has equal bargaining power, equal endowments, equal informational access, and the like. It's just not the way most markets are, and probably never will be.
What would it take to abolish the speculative market? If you think that's even possible, or maybe not abolish, because as we've said, a small number of producers do need this to some extent for their own security of production, etc. But the size of it is just entirely disproportionate to its use. How do we reduce it to an ideal size? And what would an ideal size for it be in the first place?
So, ideally, what you would have, I think, and again, this is sort of a somewhat hazy first pass at or first attempt at a kind of characterization. But if you use the idea behind the insurable interest doctrine as a kind of touchstone, a kind of normative touchstone, then what you would have is, ideally, you would have enough counterparty interest in a betting market to sort of equal the interest of those with actual insurable interests to seek insurance in the market in question, right? So, the insurable interest doctrine ensures that you don't have 1,000 different insurance companies all betting on Patricia's house, right? Or the sort of fate of it. You have one insurance company per Patricia, so to speak, that's doing that, or at least one policy per Patricia. And so if you thought in terms of people who have legitimate insurable interests in various markets, like with respect to the prices of commodities of various kinds, or other sorts of things whose prices are important. If you thought of that as a kind of market-wide analog to the insurable interest doctrine, you think of the people who have legitimate reasons to be worried about particular price volatilities on the one hand, and then imagine roughly doubling the quantum that they themselves are prepared to bet by basically assuring that you've got counterparties for all of them. That might be a kind of a first pass at about what size a market should be. Needless to say, of course, just as you suggested a moment ago, Patricia, the actual derivatives markets exceed that kind of size by many, many, many orders.
Yeah.
The notional value of derivatives exposure outstanding just dwarfs gross domestic product, for example, let alone actual manufacturing and the provision of actual sort of physical services that people need. The next question then becomes, all right, well, how would you sort of, in effect, simulate an environment of that sort, or how might you make the present environment come to look, size-wise at least, like the environment I just sort of ideally imagine? And there are various ways to do it, but probably the two best ways would be either to sort of fine-tune the legal regime governing borrowing, speculative borrowing in those markets, or to do the kind of counter trading of the kind that I just noted, or that basically is advocated in the two Forbes pieces that we're talking about. So to start with the first one, right, to limit the availability of credit in those particular markets, and in that sense to kind of micro allocate credit, the simplest and easiest way is just to impose higher margin requirements on the traders. In other words, getting back to the way you characterized it, Patricia, requiring that more money be put down and allowing less then to be borrowed. An analogy that might be intuitively tractable to some folk would be, again, the case of mortgage lending and home buying, right? So for many, many decades in most of the sort of common law jurisdictions, it was typically required that people put down at least 20% of the price of a house, and then they could borrow the remaining 80%. And so there was a limit on the so-called loan to value ratio, or LTV, of 80%, right? That's just the other side of the 20%. And, in more recent years, I'd say up to about the early mid-1990s, we got to a regime where people could put down as little as 10% on a home and then borrow the remaining 90%. And that too seems to have been more or less manageable. But things, of course, got a bit crazy and out of whack once we let speculative institutions start securitizing mortgage loans and then packaging them into mortgage-backed securities and then enabling nominal, supposed insurance companies like AIG and MetLife to fabricate derivative instruments, credit default swaps of various sorts associated with those MBS. All of those developments made it possible for people to put down literally 0%, and sometimes even negative down payments, in the sense that they would be paid rebates or bonuses by the lenders to borrow from them to buy the homes, which of course is, maybe in the short term good for some of those lenders and maybe even for some of those borrowers, but it didn't take long for the underlying dysfunction of that sort of arrangement to manifest in the classic sort of Minsky style. Now, the analog for that in the derivatives markets would be essentially to require those who borrow to buy, to sell, to post more margin. That's the equivalent of a down payment, so to speak. It's sort of the equity stake that we would require be put in. That's one way to do this. And most regulatory regimes in most countries have various sort of entry points or doorways through which required margins can be adjusted. The one possible disadvantage of that modality in some jurisdictions is that those sorts of changes to margin requirements, and in particular, the capacity to impose those requirements countercyclically, in the sense of raising them when it looks like a boom is underway and then lowering them when things kind of calm down, typically requires a fairly lengthy process of rulemaking and then public comment and then final approval and so forth. So it can take quite a while to change the margin requirements that are part of our capital regulatory regime in the US, for example, in various markets. It's much quicker if you have a giant counterparty like the Fed able simply to change its purchasing quantities on a daily basis, which is, of course, what the New York Fed trading desk does each day in the Treasuries market. And, of course, what a newly opening Fed trading desk at the Chicago Fed, conveniently located by the Chicago Mercantile Exchange, the world's largest derivatives markets, could also do. So my own view is that, yeah, I'd love to have the margin requirements changed. And that's a very potent tool as a form of capital regulation. But again, it's hard to change the specific rule on a sort of daily basis, even on a monthly basis or quarterly basis, let alone a daily basis, such that it's probably a good idea, I think, to allow the central bank or some similar entity to engage in the kind of market activity that I'm talking about. You guys might remember, I think we talked about the Financing the Green New Deal book back in 2020 when it was new. And one of the primary proposals in that is something I call a price stabilization fund, or AKA the people's portfolio. And the idea there is just to have a great big portfolio that mirrors the markets as a whole, that either the Fed or some other newly created public instrumentality would manage with a view to affecting systemically important prices, even while not, sort of tampering with other kinds of prices. I think that would be the optimum in terms of sort of optimal, fine-tuned, fuel injection style, flexible monetary policy. I hasten to add, again, this is a way of dealing, I think, with these sort of short to medium term perverse side effects of monetary easing. In the longer term, I think the way you address inflation is to address, of course, the productive capacities and productive practices of the underlying economy. If inflation is, as the sort of bumper sticker rendition has it, the problem of too much money chasing too few goods, and if deflation is the problem of too little money chasing too many goods, one way to sort of, maintain that balance is to work on the goods side while you're working on the money side. And the money side is quicker, so you can work there more quickly and more readily. But in the longer term, you really want to be working on the goods side, on the production side. And so that's why, as you guys have probably noted, a lot of what I've been putting out in Forbes and other venues recently is about how to boost production, how to sort of make this a productive economy again, where everybody is able to sort of hold the kinds of well-paying, life-sustaining, family-sustaining jobs that used to be much more common up through the 1960s.
Something we've not talked about before is stock buybacks. Would you include an increase in companies doing stock buybacks as one of those undesirable consequences of monetary easing?
Oh, absolutely, Christian. And that too, by the way, can play in to at least the sort of short-term inflation problems, right? There are a couple of, let's say, market dysfunctions that have been sort of targeted by everybody's favorite U.S. Senator Bernie Sanders and others for some time now, that play a role in all of this, in the current temporary inflationary spikes, but that are also worth preventing or prohibiting for other reasons in addition. And for that reason, people like Bernie here in the States and his counterparts elsewhere have been sort of pushing to rein these things in, these practices in, even before the recent and, I believe, transitory inflationary spikes here in the US. So one is the corporate share buyback problem that you just noted, Christian. Cheap money is just money that you can get hold of and borrow really inexpensively. And if there aren't any limitations placed on what you use the proceeds of those borrowings to do, then you can imagine that stock buyback activity might very well spike during times of monetary easing. And lo and behold, it does. That invites the question, well, why? What motivates it? What prompts it? And here too, there's in effect what's happening is the cheap credit is enabling people to exploit and capitalize on and profit by a very specific dysfunction in the secondary markets. And that is the distortion pursuant to which prices in secondary markets, that's to say the prices of securities issued by corporations that might produce goods or provide services, for those prices to sort of get temporarily, at least, out of alignment with the actual long-term value of the company, which is typically unpacked in terms of what it produces and how much money it can make by selling that which it produces or what services it provides. So over the long run, one expects that securities prices, in particular corporate equity prices, are going to be in some kind of alignment with and sort of tethered in some sense to the long-term prospects of the company as a maker of things that people buy and pay for. And that is probably true in the long term, but the long term is very, very long, and the short term can be pretty long too. And you can temporarily, even for rather protracted periods, for as long as liquidity lasts, inflate or pump up the price of a security in a manner that has nothing to do with fundamentals. And share buybacks are just that. These are just corporate executives pumping up the prices of the shares of their own companies because their own paychecks and their own bonuses are themselves tied to stock performance based on the outdated and altogether false notion that the share price at an instant is a good indicator of the value of that company. And it's not. The share price at an instant is not a good indicator of the long-term value of the company. And one of the best bits of evidence of that is precisely the fact that when there's monetary easing, suddenly you see the buyback activity spike, and lo and behold, you see the share prices spike because you've got a sudden influx of demand for those securities, and nobody seems to pay attention to the fact that the influx is actually not natural, quote unquote. It's not because the company suddenly became more attractive to outsiders. It's essentially a form of price manipulation that's being engaged in by corporate insiders. Now, that form of insider trading is already illegal. It's just that we give stock buybacks an exemption from that. Ordinarily that would be considered insider trading. So people like Bernie and other progressive legislators here in the US have long been saying that that should simply be prohibited as it used to be. That is definitely, I think, part of the problem. It is itself another one of the, sort of unfortunate side effects of monetary easing that is otherwise overall a good idea, unless we, fine tune it.
Just to be clear on the stocks buyback. So stocks buyback is simply a company buying back shares that it had previously issued to the market.
Exactly.
And I imagine shares as a liability to the company that it issued to other people. And the buying back of these shares is the settling of that liability. In principle, it's difficult for me to think of it as a negative. But when you talk about it in the sense of this being done as a means to ramp up on the short term, the share price, in order to indirectly benefit key directors within it whose wages are in themselves tied up or their bonuses are tied up to the share price, that seems to me quite dodgy. Is it that buybacks in themselves are bad, or is it the reasons why buybacks are being done, which is the negative here?
I think it's partly the reasons that they're being done. And I think it's also a matter of the spillover effects or the sort of third-party effects of an artificially inflated stock price. If one thinks simply in terms of the company and its shareholders, right? If you think basically of the party and the counterparty, so to speak, and don't think about third parties, then you can sort of think, well, what's not to like, right? Patricia voluntarily bought the ownership stake in this firm. The firm is now buying it back from her. She's not being forced to sell it back. She's presumably benefiting by this because she's receiving more in payment for this stock share than she paid for it herself when she purchased it. So, what's not to like? Shareholders benefit, management benefits, blah, 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 right? The trouble comes in the longer term, and that is because when other entities, lenders, suppliers of intermediate goods that go into the production of the firm's products, investors, people who maybe lend to the company, creditors, bond buyers, and so forth, when they themselves use stock prices as signals of the underlying value of the company or the underlying sort of long-term prospects of the company, which they tend to do as a matter of sort of benchmarking practice, you get distorted decisions having to do with the allocation of capital and the allocation of resources, right? So there's that problem tends to occur over time. It also, of course, tends to sort of sharpen in the medium term the sorts of inequality problems that have been endemic, especially to, once again, common law jurisdictions, but in the so-called developed world more generally as well, between those who own stuff and those who are, rented by the owners of stuff, right? So insofar as you guys and I earn wages or salaries, we're basically rental property. I mean, we're being rented by somebody, right? By capitalists, by owners. Whereas the capitalists own, right, the entities that are renting us, that are renting our labor power. And as you guys know, I mean, really one of the most conspicuous dysfunctions that's been occurring in so-called Western or developed economies over the last 50 years is this enormously growing gap between the owners and the owers, or the owners and the rentees, or you might say the rentier on the one hand, and the rentees or the rented folk like us on the other hand. And this kind of activity tends to do that too, because what happens, of course, is that the share owners, Patricia probably in our example, and maybe in a sort of combined happy and terrible dream that Patricia might have, Patricia herself, are rendered wealthier by these sorts of things.
Because if my house burned down, then I insured it.
Yeah. And if you pocket the gains and sort of make off with them, and then later on, the company, when it gets back down to fundamentals, is not performing so well, so that the shareholders who are still involved with it now suddenly lose. And maybe more importantly, those whose labor services are being rented by the company suddenly find themselves furloughed when the company gets into financial trouble. Over time, a kind of constant iteration of this sort of dynamic just worsens the inequality problem. And as I think we've talked about in earlier, those inequalities themselves have really long-term problematic effects, not just with respect to social justice, which is the most important effect, but also a somewhat familiar, at least, effect, but also even with respect to financial volatility and long-term macroeconomic stability itself in the long run. Basically, what I'm essentially alluding to then are the effects on third parties as distinct from, say, the first party and second party. That's to say the party and the counterparty, or the company and the shareholder who sells the shares. The other thing maybe worth noting here is, and I think Christian might have alluded to this a moment ago, and we're hearing it from some of our progressive friends, of course, is that, lack of competition, monopoly and oligopoly in various markets is also contributing, of course, to inflationary pressures. Less competition means it's, of course, easier for companies to jack up their prices and the like. And I think that's an ongoing and important effect, or I should say causal factor right now as well. The one reason I don't tend to emphasize it or focus on it is that I think that that's been a problem for much longer than the recent temporary or transitory inflationary spike has come up. And so it's a sort of a long-running interest or concern of mine and ours and lots of people's. And I think that, we'll see more and more moves to sort of rein it in or act on it going forward. But I don't think it's a sort of uniquely to blame for the current sort of temporary spikes. I think that's more, the more proximate cause of all of that is, again, the kind of leakage from the monetary easing that's underway right now that we talked about in the medium term. And in the long term, it's also, a decline in productive capacity in the industrial countries that are kind of deindustrialized these days, ever since their capitalists found that you can find something close to slave labor abroad where there isn't any labor law.
This whole conversation is driving me to conclude that prices aren't really a very good indicator of value.
Yes, exactly. That's the thing. It's so funny, isn't it? I mean, I guess I shouldn't say funny, but it's rather remarkably ironic, because it's probably the most fundamental thing, or the most basic takeaway that all of the economics 101 courses, sort of try to encourage us to think, which is that market price is a good measure or a good reliable measure of actual long-term value or worth to people. And, that's truer in some markets than in others. And it's truer over the longer term than over the shorter term. And if all we do is think about the long term, or if all we do is think about idealized markets, then it becomes pretty easy completely to overlook the short and even the medium term. And that would be bad enough if those effects in the short to medium term were themselves just temporary. But as you guys know, because of various sort of feedback mechanisms that operate throughout modern decentralized exchange economies, sort of so-called minor or, sort of minor major distortion in the short term can become sort of self-reinforcing and self-augmenting over the longer term and become much worse, right? So it really won't do, it seems to me, to sort of think in simply idealized terms and the long run all the time, when policy inevitably has to be about at least the medium term and very often about the short term too. People die in an instant, they don't die over the long term. Even right now, people are dying because of all of these ridiculous mistakes that we're still making.
So just to cap off the stock buybacks question, what I'm taking away from it, and either of you correct me if I'm wrong, is in more rational times, it would be called insider trading. And really the way to deal with that is to call it insider trading again. And your proposal, Robert, about monetary fine tuning, it's not necessarily aimed at stock buybacks. The stock buybacks is just a bad development that needs to be undeveloped.
Yeah, I think, so one way to kind of frame it that coheres perfectly with that, Christian, and that your framing just now kind of serves as a great sort of on-ramp to, is if we think about monetary easing and then the leakages that can occur when it happens, we can think of it from either of two sides, right? We can sort of think, okay, start with the easing in a kind of a broad brush or cast a wide net sort of sense, a blunderbuss sort of way. And then, kind of look for individual perverse consequences or dysfunctions that occur here and there or hither and yon as a consequence, and then plug those specific leaks, and otherwise just let it, keep casting the net widely and let it keep sort of, flowing where it will until new dysfunctions are spotted, and then close those off too. That would be one way to proceed. The sort of flip side of that would be to say, well, rather than just casting the wide net from the get-go and then just drawing it in piece by piece according as specific dysfunctions kind of turn up, maybe actually narrowly target the easing itself in the first place, right? So if you think, well, one source of flagging aggregate demand in the economy under pandemic conditions is that, companies are suddenly seeing their profits squeezed, and so they're furloughing workers or laying folk off. Well, why don't we provide incentives or subsidies for them to keep those people working, keep them employed, even when they're not making more money? In other words, why not do something kind of like the so-called Paycheck Protection Program that was, once it was finally tried here, it began to show its mettle fairly quickly, but that we came to really late after other jurisdictions, notably Denmark, showed its workability first. That way, you're sort of addressing a specific problem through appropriately tailored means, and you don't have to worry about then looking for leaks later that you have to plug, unless there's fraud underway where companies are taking money from the Paycheck Protection Program but then not actually paying the paychecks. But that's sort of a different matter. I myself don't have a particularly strongly settled opinion one way or the other as to which is the best mode of proceeding, go wide and then narrow, or go narrow and gradually widen. I think ideally you would just, address the specific problems that there are through specific means, but that might in some circumstances not be possible. Ideally, you might, as a practical matter or as a matter of acting quickly with appropriate expedition, you might just have to go wide to begin with and then plug the leaks as you find them. So it could be that in some circumstances you can start narrow and then broaden out, whereas in other circumstances you have to start wide and then narrow. But as a general matter, whichever sort of side we start from, narrow to widening or wide to narrowing, either way, it seems to me that the critical thing is we want to see to it that the sort of newly available cheap money is not flowing to where it ought not to be flowing or where it's not intended to flow. And stock buybacks are one place where it's pretty clear that wasn't the idea, that wasn't the intention behind the loosening of monetary policy any more than commodity speculation was an intended effect of monetary loosening.
And with the MMT podcast, we think the natural rate of interest is zero. I don't want to put words in your mouth, but what you're not saying is the money's too easy, so we should raise interest rates. Yeah,
no, that's exactly, Christian, one thing I'm not intending to say. My own view is that, productive capital, basically financing for actual productive projects of various kinds, ought to be freely available. If you think in terms of sort of optimal justice as essentially an equalization of opportunity on the one hand and risk on the other, let's say opportunities for which people are not individually responsible and risks for which people are not individually responsible, it seems to me that we should all basically face equal risk, at least when the risks involved are risks that we're not responsible for. So if you draw a bad, sort of ticket in the birth lottery and are born with some genetic ailment, seems to me that the healthy in society actually owe you redress to sort of see to it that you are able to sort of maintain yourself and lead a reasonably productive and rewarding life, because your affliction is no fault of your own. And if you think of, justice on the sort of, when it comes to burdens, as being about that kind of risk equalization, then a sort of counterpart on the benefit rather than burden side of the ledger, so to speak, would be equal opportunity. And there are lots of different spheres of opportunity, but one is the opportunity to be productive, or the opportunity to produce and create, or the opportunity to construct a meaningful life in collaboration with others, or even by oneself if one is of that sort of disposition. And one great way for a society, it seems to me, to more or less ensure that there is equal opportunity of that sort, is to see to it that abundantly available credit, which credit is now, is indeed abundantly available to everybody, which is to say it's available without interest, or it's available at no charge beyond what is legitimately necessary to mitigate against the risk of loss in some cases or something of that sort. And in that sense, I'm very much in line with Warren, with Randy, with Matt, and of course with J.M. Keynes before them. Right? I think the right understanding of Keynes, especially Keynes of the Treatise on Money, is that the natural rate of interest is something very close to zero, if not indeed zero. So I would never be in favor of a sort of a general interest rate that's positive, and certainly not one that's above, 0.25% or 1% or whatever. But even apart from that, it's hard not to abhor and deplore really sort of broad brush styles of credit policy, right? The language I use is the language of modulation and allocation, right? So the way present policies seem to be constructed is that it sort of takes for granted, I think, a falsehood as a truth. And that is that you can sort of separate the modulatory task from the allocative task. Now, what do I mean by that? Well, if you think the modulatory task is to ensure that credit aggregates are not sort of too large relative to the resources of the community, right? That's inflation essentially occurs when credit is so superabundant that it exceeds the capacity to be used productively. And so then people start bidding up the prices, either of already produced goods or of the resources that we use to produce goods. That's essentially what an inflation is. It's a sort of excess of credit money relative to the resource base. By the same token, a deflation is simply the opposite problem, right? Where you have a inadequate credit money availability relative to the resource base. And the modulatory task, as I see it, is basically maintaining a kind of rough balance between credit money availability on the one hand and the resource base on the other hand, right? Now, we've tended to think, or at least policymakers, insofar as they think about these things carefully at all, I think there's a tendency to think that modulatory task can be executed without regard to allocation. In other words, that we could talk about the quantity of credit without talking about the quality of credit, or talk about the total of credit without talking about the directions of the flows of credit. But that just turns out to be false. You have to pick winners and losers, so to speak, in order not to get inflationary bubbles of the kind that we had in the lead up to 2008, and in order not to have deflationary crashes of the kind that we had after 2008. You have to, in other words, fine-tune the flow of credit money to see to it that it's flowing in productive directions rather than simply in price bid up directions. So if you let it get into, stock buyback markets, for example, to go back to your example, Christian, what you see essentially is just an artificial inflation of share prices that has nothing to do with underlying value, right? And similarly, in the housing markets during the Greenspan years in the 1990s, you saw housing prices just shoot through the roof because credit was misallocated to those particular markets. And then when those markets go bust, other markets that weren't misallocated credit end up being caught up in the storm. So I think you've got to sort of allocate credit carefully in order even to modulate it successfully, right? In order not to have bubbles and busts. It doesn't mean you have to, sort of be micro allocating, like, oh, let's see to it that Starbucks gets some credit, but let's see to it that Dunkin' Donuts doesn't, or something. But what you can do is broadly distinguish between productive uses and unproductive, merely speculative uses. And the greatest irony, or at least one of the great ironies, I think, at least on the American scene, is that the Federal Reserve was originally designed to do just that. We usually hear the name Carter Glass here in the US in connection with the Glass-Steagall Act, and everybody thinks rah-rah because the Glass-Steagall Act was a good idea, separating actual sort of business banking and commercial banking from merely speculative investment banking. But what tends to be forgotten is that long before Mr. or Senator Glass pushed the Glass-Steagall Act, he also designed the original version of the Fed. And the original version of the Fed was meant to make credit freely available, publicly available, for productive uses by small businesses, by companies that were actually making new things or coming up with new methods of making things or providing actual needed services on the one hand. And it was to deny any public subsidization or public backstopping of credit that was provided or offered solely for speculative purposes, to bet on Wall Street or to go down to Las Vegas to sort of use on the slot machines because you came up with a formula that you think enables you to win. And that worked pretty damned well. But of course, Wall Street wasn't particularly fond of it for that very reason, because it essentially cut Wall Street out of the sort of public credit subsidization story. And so, as you guys know, a big part of what I've been advocating for a few years now is this project I call Spread the Fed, which is essentially to sort of reinstate that old role of the regional Federal Reserve Bank, district banks, in discounting commercial paper issued by productive enterprises and not discounting any paper issued by speculative entities or agencies like hedge funds or the like. That, I think, would be absolutely transformative. And that model wasn't invented in the U.S. It was actually kind of copied to a certain extent from the German Landesbanken and Sparkassen model that had come into prominence in late 19th century Germany, and to some extent is still operative there now. And it's no accident that Germany tends not to financialize in the way that most other of the so-called capitalist or developed economies have done, and it tends to be healthier in that sense. It continues to be a productive economy with lots of manufacturing and lots of employment in those high-paying sectors. Seems to me that we in the Anglo-American or the, again, what we might call the Anglosphere or the common law world, all of which sort of share a common defective DNA that came from the British Isles, would do well maybe to kind of rediscover that model of finance. And intriguingly, Keynes himself seems to have developed a lot of his better ideas in this connection through encounters with really deep thinking German statespersons in the financial sphere and German-speaking thinkers on economics and finance, including the Swede Knut Wicksell, who we talked about last time in 2020, and of course Melchior, the finance minister of Germany during the first 20 years of the 20th century.
What, in your opinion, might break this inflation that we're experiencing at the moment here at the beginning of 2022?
I think it's actually fairly straightforward. I really do think it's all about supply right now. And we're hearing, as you guys have noticed, across the world, in the US, but also in Australia, of course, and in New Zealand and Great Britain, that, quote unquote, supply chain problems are what's behind this, right? That all of the outsourcing and the sort of just-in-time production methods and the sort of global networking of productive production chains and then delivery and distribution channels have played a critical role in all this. And all that's true, I think. But the thing that seems to be being overlooked right now, to my consternation, is that when we talk about a supply chain, that we're really sort of talking about two components that are, worth distinguishing for sort of practical purposes or, sort of policymaking purposes. One is the channels of the supplying, right? The act of delivery, the act of, moving things around. But the other is the actual production of the things that are moved around, right? So we might say, let's distinguish between the supply chains on the one hand and the actual supplies on the other, or the supply modes on the one hand and the supplied things on the other. Now, what's happened, as you guys know, in a lot of the so-called industrialized world or developed world is we've basically hollowed out when it comes to the production of things, right? I mean, to take one example, semiconductors or microprocessors, or better known as chips here in the US, we used to manufacture pretty much the entirety of our domestic needs all the way up into the 1990s. But then during, of course, the wonderful, utopia of the Clinton years, that stuff all began to sort of outsource to places where labor was underpaid, where basically capital could extract more from labor, to the point where now the U.S. doesn't supply. I think we supply about 12% maybe of our needs. And then we rely almost entirely for the remainder on a few very insecure sources. One is China itself, with which the U.S. seems to be engaging in an ill-advised sort of new Cold War. And then the other is Taiwan, which whose days might, as a major supplier independent of China, I hate to say it, but might be sort of numbered. And I really do think that what we have to do across the so-called developed world is actually earn our name again. We're not really developed in the way that we once were. And it seems to me it's time to redevelop and actually reshore production in a big way so that you don't have to worry about how long the supply chains are or how much transit has to be engaged in by various component parts of various finished products in order actually to have enough goods to supply the heightened aggregate demand that has been happily induced or undergirded by monetary easing and the like. Now, I hear sometimes, most people don't seem to be thinking about that. They seem just to sort of lump together, everything under the heading of supply chains, and then to think in terms of trucking routes or truck drivers or warehouses or ports, but not what's being stored in the warehouses or shipped to the ports. So that's one problem. But then compounding that problem is that even the few people who do think in terms of actually producing again will often say, yeah, but it takes 40 years to build a semiconductor factory, and it takes this much time to build this and this much time to build that. Well, that's kind of BS as well, because that's a choice, right? You don't have to wait for private sector companies to take 10 years to build factories. You can publicly build them really quickly. And here I'm fond of an example from the US playbook again. And not because I'm an American. If anything, that actually is a cut against it, but it's just because it was an enormous success with which some American historians at least are familiar. And that is the Second World War mobilization, right? So when the Nazis overran France in a mere 6 weeks in April of 1940, which nobody expected, right? Everybody thought that there was going to be trench warfare and protracted stalemate again between Germany and France, as it happened in the First War. So when Germany overran France in a mere 6 weeks in 1940, everybody outside of France who wasn't a Nazi sort of said, holy shit. I mean, they're actually able to move pretty quickly. Maybe we better, kind of arm or do something about that. So Roosevelt goes to the US Congress in 1940. And that year, the US aircraft industry had produced barely over 3,000 planes in total. And he said to Congress, you know what we need to do? We need to be able to produce 50,000 warplanes a year, not 3,000. And everybody laughed at him. Ha ha, it takes 50 years to build a factory. Didn't you see what happened with the last, Intel project? People laughed in the same way. But what happened? Well, at the end of 1940, we had produced 60,000 planes. And in the following years of the war, we produced even more. And that's not even taking account of all the Liberty ships, the warships, the other war material, entire new industries like synthetic rubber, because of course we had previously gotten it all from Southeast Asia, which had inconveniently been invaded by Japan, who turned out to be the ones we were at war with there. All of this stuff was done, and it wasn't done by providing tax breaks or tax abatements or tax incentives to private companies.
Or interest rates.
Yeah, or interest rates.
Just ease the interest rate.
We just built the shit. I mean, we built the stuff. We created a company. The federal government created a corporation. It was a public corporation. It was like a Chinese-style state-owned enterprise. It was called the Defense Plant Corporation, and they built 51,000 factories in this country. Imagine 51,000 factories. And then they leased them cheaply to companies that knew how to produce things in them. And then they did more than that. They thought, well, a mass labor force is going to have to move close to these factories to get employment. So how about we build neighborhoods for them? So there was a Defense Homes Corporation that built all the housing, and it was all really good housing. And then they said, they're going to need medical care and health clinics in these new neighborhoods around these factories. So they federally supplied health clinics, basically free healthcare. And they thought, some of these people are going to have kids. They might need daycare and they might need schools. And so the feds had like the Defense Schools Corporation or something. They just built a new Defense X Corporation for every X. And they just built all this stuff and made it available. And a consequence was that by the end of the Second War, the US accounted for 60% of global GDP. Now, it seems to me that if other countries and the US were all doing this, and it's more possible now because at that time, of course, those other countries were being invaded and the US wasn't. So that was why we were able to sort of do this even when others couldn't. But, absent invasions and bombings and stuff, I mean, all the countries of the world can become massively productive following a model of this sort, it seems to me. And then, we might very quickly find ourselves dealing with the opposite problem again. Okay, how do we prevent deflation? Because we're producing so much. And there's a nice, easy answer to that too. And that is, we'll share the proceeds of production more equitably with those who are actually doing the producing. That is to say, the workers, instead of the rentier, instead of the shareholders.
So before we go, some of your proposals to spread the Fed are before Congress as we speak, I believe. Is there any news there? Can you tell us how it's going?
Yeah, it's going actually remarkably well. And I think I hesitate to say this in one sense because I've been saying this for a while now. And if I had been correct in all of the previous prognostications, it would be old news by now. But we really do seem to be poised to pass a major piece of legislation that's going to be sponsored by people in both political parties, believe it or not, in both houses of Congress. What it basically involves is essentially several means of sort of replicating with currently existing federal instrumentalities something like the set of institutional arrangements that made possible that Second World War mobilization that I just mentioned, that I just talked about, right? There was a particular set of federal institutions that all were able to sort of work in tandem in the 1930s and especially the 1940s to sort of transform the US economy from one where only 50% of capacity was being utilized to one where not only 100% of capacity was being utilized, but additional capacity was developed and then it was fully utilized. So to sort of basically replicate the means by which we accomplished that particular public-private miracle is the task of this particular bill. And it does that, including by spreading the Fed in the way that we were talking about.
That's a great place to leave it. We've been talking to Professor Robert Hockett, consultant on public finance and author of, among other titles, Financing the Green New Deal and co-author of Money from Nothing. And we'll link to where you can find all of Robert's work and his essays in the show notes. But for now, thanks for joining us today on the MMT podcast, Robert Hockett.
You bet, guys. Thank you so much, Patricia. And thanks so much, Christian.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.